Welcome to the Business Results Program. This is how to transform yourself, your team, and your company to perform better and achieve higher results. Let's get started. I'm so happy you're here. My name is Pete Winarski, and I'm the CEO of Win Enterprises, LLC. Check out CompleteBusinessTransformation.com and look at the latest posts and resources we put there to serve you. I started this program because I want you to know that it doesn't have to be that hard. Business leaders like you struggle to get results, to build your team, to satisfy customers, to grow your businesses, and to stay sane in the middle of these crazy dynamics going on around you. My team and I have had full careers in business leadership roles, and we get it. We've had the same challenges as you, and we can share what we've learned, and we can make your life easier. In this program, I will be joined by various members of our team and other guests that I know can help you. We will offer new perspectives and share some of the secrets that you're just not hearing about anywhere else. The Business Results Program is your personal journey to improve yourself as you improve your company and achieve your most important goals and deliver the business results that make you and your team happy. Now, let's get to today's episode. Hey everyone, Pete Winarski here. This is Business Results Radio, and I'm here today with a great friend and guest, the CEO of Almeida, Anthony de Almeida. Anthony, welcome. How are you?
Thanks, Pete. I'm well. How are you doing?
Fantastic. We're going to talk about Almeida today because this is really a big deal project for you, and it's going to impact a lot of businesses and really give them a hand in their success. Let's start out with, what is this Almeida thing?
Well, before we jump into what is Almeida, I think we also have to, you're not giving yourself enough credit. I think you've been involved with Almeida as well. So I love the humility, of course. But Almeida wouldn't be where it is today without the help of yourself and David at Win Enterprises. So what is Almeida? Well, Almeida is something that I had been seeds had been planted years ago in my head with my previous firms I was either working with or I was part of. There was always a bit of a frustration when it came to companies that were seeking financing. They weren't getting the answers that they needed. They were being left to the side by the lenders. It would take forever to get answers. It was very frustrating. And as you are very well aware, when businesses need capital, they need it yesterday. When a lender is telling you after 8 to 10 weeks that it just doesn't fit for them, that didn't sit well with me. I got to the point where I'd heard this too many times, and seeing the frustrated look on the faces of very capable business owners, enough was enough. And so started really mapping out what it would look like if you could grade and score and provide not only an answer to a business owner, but support along the way so that they really understand what it is that's available and how it will help impact their business. So fast forward a couple of years of all this sort of mapping out in my brain, and you and I have known each other for years. And so I put this idea, this concept, this kernel of an idea into your brain and David's brain. And you two were a fitting co-founder group because you see the same things I do, but you see them from a different side of the room, so to speak. So when you're in there working with businesses and trying to figure out how to make them run better, run leaner, be more profitable, there's always a discussion around capital, because as you're growing, you need capital. There's no way around it. Either you're providing the capital yourself from your own pocket, or you're getting it from an investor, or you're getting it from a lender. Mm-hmm. So it just seemed to be very fitting, and the timing was perfect to grow Almeida, to create Almeida. So Almeida is actually a fusion of two words: imagine, growth. And when we were trying to figure out what to name this, and you were in the room many times, we were bouncing this around, what do we call this thing? And Imagine Growth seemed to be the right the right two words to put together, because when you're a business owner, you're always trying to figure out how to make it better, cheaper, faster, more profitable, increase your efficiency, build a process around what you're doing, what you're offering. Of course, you're very well versed in that area. So when you're doing that, you're trying to figure out, how am I going to do this? You're trying to imagine this process. You're trying to think 10 steps ahead. So imagine growth seemed to be the two words that were the most suitable. So that's where Magro came from.
I remember some of those early conversations. You're like, there's the frustration that business leaders have when they try to just go the traditional route and they call the bank that they know they're one banker. They, where's my operating account, right? So they go in there and they have the conversation. We were in this boat at one point when enterprises, we had some ideas that we were going to put some money towards and see if we can accelerate them. Happened to be right before COVID. we were going to double down on some marketing initiatives and some things. And that duration, the lead person's like, yeah, everything looks really good. Just got to give it to the underwriters. And then it became, have you heard anything yet? Have you heard anything? It's like, what's going on? And then, of course, COVID blew up the world, and probably a good thing at that moment. But yeah, it's just like, it's a strange process. Like, why does it take so long? So, the idea of Imagro, part of our conversation here today, I appreciate you bringing me into the fold, because I have been, sort of a little bit humble in this conversation as the podcast interviewer to you, the CEO of Imagro. But at the same time, yes, we're in this together. Now, let's articulate those things that Imagro is solving, because I think a lot of people don't really understand the process. They think, hey, if I'm a business owner, I've got this, whatever, $1 million company, $5 million company, $100 million company, and I got to go get some money to fund capital equipment or working capital or whatever it might be. That's easy. I'll just, make a call and have a bunch of money land in my lap tomorrow. And it doesn't really work that way. So
if only it were that easy.
Walk us through that.
Yeah, absolutely. So I think there's two sides to it, as a borrower and as a lender. So from the borrower's standpoint, there's always pain points around, like we mentioned, time, right? And then figuring out, where you can get the money from is always a concern, because, again, like you mentioned, the banks are always, the first choice, but they're not always the only choice. And once you're disappointed from the response that you receive, then you're sort of back to square one. What do I do? So from a borrower standpoint, that's a really painful part of the process. And then the pricing and the amount that's available to you. Most people, if you may need $2 million, but how do you know that you can even get $2 million, right? And what does that look like? And how much is that going to cost? And can you even afford to make those payments? So there's a lot of things that, from a borrower standpoint, that are very unclear. From a lender standpoint, there are pain points in the process as well. For example, lenders are always looking for good files, good transactions, good companies to fund. They don't always get those readily brought to them. They have networks or brokers or whatever you want to call them that may feed them business, but everyone sort of gives them the package differently. They receive information differently depending on who they're receiving it from. So there's no uniformity to a process, really, when it comes to these sorts of transactions. So we wanted to solve three main problems that we noticed, and of course you're in the room, you noticed these too. We were putting our heads together, and we narrowed down the three biggest problems that we see. In my 20 years of experience, it was always these three sort of, want to call them sort of firewalls, right? These three gates that really stopped a transaction from moving forward. One of them had to do with the origination. That was the first one. So not necessarily a gate per se, but origination is a really important part of a lender's business model, right? Where are they getting their business from? Do they know their client? Do they know the broker or the business consultant that's bringing them that file? How is that being provided to them? In what format is it being provided to them? Is it summarized in a way that is clear and concise and delivers the message properly so that an assessment can be made quickly? And you'd be surprised how many intermediaries out there don't know how to put that summary together. So
they're just throwing it over the wall, right? There's like Hey,
Yeah,
lender, here
it's
you go.
we joke and we call it the spray and pray, right? So they're just throwing it out and we'll
Mhm.
see who it sticks
Right,
to.
right.
So everything we did when we were building this, as you know, was based on a rifle approach. We're going to be very specific about how we get the clients, how we put the packages together, and how we submit them. So origination is a big part of that. It's where are you getting the clients from? Do you know your clients? Are you vetting your clients? When you
Mhm.
deliver the client information to the lender, have you done a good enough job that the other two pain points that we talk about are easier to deal with? So the second pain point is the underwriting. Now, lenders, whether they be banks or alternative lenders or completely private lender sources, um, they all have an underwriting process. They do their own adjudication, they do their own analysis in house. They have to figure out if this file is suitable for their funding program. So, underwriting is a really important part. And so, this is generally when we see the biggest gap when it comes to timelines and waiting for an answer. That's when that sort of 6, 7, 8 week turnaround, really starts to become the pain point because underwriters, depending on the size of the lender or the department, there could be 3 or there could be 30. But if they're a national company and they have 30, well, they've got so much volume that those 30 are overloaded. And if
Mhm.
they're a smaller company and they only have 3, well, if they have a good channel of business coming in the door, we've seen it many times. The underwriters are so overloaded that you send them a file and you call them in a week to check in and they say, I haven't even looked at it yet. It's like number 10 down the queue. So that's a really frustrating part of the process because it just goes down the chain and it frustrates everybody down the chain, frustrates us as an intermediary, as a support person, and it frustrates the borrower because they need the money and they don't have an answer. They don't even know whether they're on the radar at all. So that was the second pain point. The third pain point is the risk mitigation side. So there are a lot of borrowers, companies, businesses who are great. They operate well. You see them all the time. They're really good at what they do. They have an amazing product. They have an amazing team. Their financial statements may not reflect that necessarily. So because they may have just had such explosive growth and they need to catch up and they need to fill gaps. And we see that so often. Unfortunately, that doesn't fit for a lot of lenders. So, on paper, they don't look as good as they do in real life.
Right.
So there was an important piece missing in the underwriting side, which was the risk mitigation side. And what it comes down to is how can we make this company look better on paper, but how can we also give the lender comfort that, hey, it's not going to be a fund and then forget about it unless they default. It's going to be a fund and hold their hand along the term of the loan so that the lender feels comfort, knows that there's support. They don't have to get involved, but they know that somebody is there protecting their funds. So that's the third piece.
Yeah, so a lender is they're essentially placing a bet that you're going to use the money well, get the ROI hopefully that you are hoping to get when you requested the
Mm-hmm.
money in the first place. But most importantly, from the lender's perspective, they're going to get their money back. And so,
Right.
that risk mitigation part is actually a pretty huge concern for the lender, right?
It
And
is.
actually, it's an opportunity for the borrower, but it's really a concern for the lender that I think drove our internal conversations towards realizing, man, if we can come up with a solution for that part, then that's going to make there's going to get more yeses for borrowers than if we
Right.
didn't. So, yeah. So
Absolutely. And I
I
was
thought
just going to say that
keep going.
to tie a bow around that, because we asked about the problems and what we were picking up in the market and what the real sort of pain points were. So I just wanted to address how we as a company and as a group of founders solved that problem, right? So on the origination side, we decided to work with professionals who have a strong network of business owners. So CPAs, investment planners, financial planners, CPAs, insurance brokers, investment managers, anybody that works with business owners. So they're going to have that direct line into companies who require financing. So that is one way to really open up a channel of good clients that we can bring to a lender. So that solves the origination
Mhm.
problem. So
Right.
that's the solution. The second pain point that we mentioned, which was underwriting. The way we solve that is we took all of our knowledge and our experience, yours, David's, mine, Cameron's, and we built a platform that does most of the heavy lifting, so that by the time it gets to an underwriter, they've seen most of the information. We've done all the checkpoints for them based on the criteria they give us. So we know exactly what they're looking for and how they want to see it, because those are the relationships we've built with them. So all we've done is taken all that heavy lifting. We've provided them with a document package that pretty much checks off 80 to 90% of the boxes. So when they see our stuff come through, they prioritize it because they know they'll be able to bang it off quickly because we've done all the heavy lifting for them. So that's the underwriting piece. And then, of course, the risk mitigation side I discussed a little bit about earlier, where we will insert our own capable advisors to come in and report back to the lenders to give them that additional comfort and support, understanding that we've done those checks for them to make sure that their money and their capital is still safe.
Yeah, what I really I want to just go back and stress is that the whole underwriting exercise, it's really the responsibility of the lender to do the underwriting and to get it right. But usually they start with just a big stack of information, right? And what you've described in essentially the algorithms that we've put together, that Imagro has created, takes and sorts all of this pile of information from the borrower, and sorts it and packages it in such a way that the underwriter can digest it very quickly. But also, it's also predicting, hey, based on what we see and what we understand of the underwriter's criteria, here's where you land on the scale. Are you really, really high, or are you in the middle somewhere, or does it not really look that good? But at least it's, the underwriter has a place to start. They're not starting from this sea of information, which is another reason why it won't take weeks and weeks and weeks. It can go very, very quickly.
That's right. And also from the borrower standpoint, the nice thing about the system too is that it literally holds their hand as they're entering the information, as they're going through the process. And by the end of that hour exercise, they have a really good idea if they're financeable or not, because we've built that all into the system. So there's no 8-week sitting on your hands, nervous, waiting period. There is an immediate answer that, okay, you know what, based on what you've told us, we think this is where it's going to fit. We think this is going to be your interest rate range. We think these are going to be the typical fees. We think this is probably the amount that you'll be able to, to qualify for. So it's almost a pre-approval of sorts that, we've done all those checks already. If you think about a credit report, right? And the way everything is laid out in a credit report, it's very similar to that as well. It's a consumer credit report. You know what your score is, you know how things are being reported, you know that your chances of getting that car loan or that mortgage are going to be better because you know how your credit score reads, and if your score is higher, you got a better chance. So it's along those similar lines where it takes all that information and it scores you, and it makes sure that you understand that based on what you've told us, based on the information, based on your financial statements, based on the age of your company, based on the industry, based on all these factors, we'll be able to get you X. And that's something that is very, very powerful, especially nowadays when people are just so uncertain as to what's available, what's out there, and who to talk to.
Expectation setting too for the borrower. That here's a business leader who thinks, my business is amazing, I'm bulletproof, I ought to be able to just walk in and have people hand me gold, here's a gold bar.
Yeah
doesn't quite
it's not
work
that easy anymore. No. I wish.
Think about let's think about the borrowers and just getting inside the mind of a borrower. There's a lot of businesses who may not recognize how financing and getting funding, going and getting a loan could actually help them out. So think of what are those, even what's available out there. What are the types of lending products that a borrower, a business might actually have access to?
Well, I think most people think that a bank is the only, or a bank product or a bank loan is the only option out there. And we talk with seasoned business owners all the time who have either bootstrapped their companies or have just, they've gotten investors involved or whatever the case is, or they've only ever looked at bank term loans. But there is so much out there now that's available. For example, if you're a logistics trucking company, there is specific lending available for equipment financing, and it's very reasonable. So you don't have to go to the bank for that. We have equipment lending partners that will focus only on that. Real estate transactions, commercial development, redevelopment, construction, ground up construction projects. The banks aren't always, the best option for that either, just because they're very limited. Their credit criteria is very tight. They'll only lend a maximum amount. So there are a lot of secondary alternative lenders. Their money's priced well, and they've got lots of it available. And so there's specific lenders for that. Even when it comes down to invoices, purchase orders, you've got a purchase order with a sort of a long lead time, and you need to, kind of use some of that capital now. There are lenders specific for that. There are lenders that even that specialize in receivable financing. So you've got 60-day age receivables, and if you have a few $100,000 that are sitting there you may need to be paid on, you could use that now to inject into the company. There are lenders specifically that will lend on that. So, and then of course, the working capital, the typical bank loans, which of course we love working with the banks because their money is priced well. And if it's for a specific product, all day long, we'll send those to them. But there are so many alternative lending options out there that you don't have to be restricted to just, well, I don't qualify for that 3-year bank loan for $300,000. What am I going to do? Well, what's the money used for? Well, I want to buy equipment. Well, then let's talk to an equipment finance company. Let's not talk to the bank. Let's leave that for when you really need the bank, or when, you're doing a larger event and you can roll everything into a new bank financing, right?
This is a conversation. This part is really expanding, my mind and the mind of a business owner, business leader. You could be that it's the CFO role is like, I got to figure out, how do I crack this problem? We've got to come up with, so many, $500,000 or a couple $1 million, whatever. And if you're only aware of the traditional, let's go talk to the bank where I hold my operating account and see what they say, that's, as you just pointed out, there's a lot of different alternatives. And, I want to call attention, Anthony, over time, you've built up, like 200-ish, right, relationships. Think about, there's a lot of potential lenders out there. You want to just talk about like some of the different relationships that you've built?
Absolutely. So we haven't really spoken about my background a little bit, and we'll spend 30 seconds doing that. But I've been in commercial corporate finance for 20 years, focused more in the first sort of 10, 12 years on the commercial side, commercial real estate, that sort of thing. The last 7, 8 years has moved over more towards commercial and corporate finance. So I have done I've made an effort to reach out and build relationships with specific lenders in North America, a few overseas, but primarily North America. I think most people, again, are under the misconception that, it's the top 25 banks, they're the ones who lend all the money, and let's just talk to them. And if not, then, that's that. I guess there's no money available to us. But I've spoken with many seasoned business owners, even some private equity firms and venture capital firms who have never heard of some of the lenders that we work with. So that just goes to show you, and I think we've only scratched the surface at the 200 that we know and that we work with and we have relationships with. I know that there's got to be 5 times more out there, and I'm meeting new ones every day. So my background was working with specific lenders, but then the larger that my book and my business grew, the more sort of unconventional that these requests were. So rather than say, no, I'm sorry, I can't help you finance, your 60-day receivables, this was years ago, of course, you start searching around for companies that could possibly do that. And then all of a sudden you find out there's a whole niche market of lenders that will focus primarily on just your receivables. So in between everything else I was doing, I would reach out every week and meet new lenders and get to know their product and so on. So that's what built up our matrix. We call it the matrix, right? It's that sort of a lender matrix where we've got all these contacts and we keep in touch with them bi-weekly, monthly, just to make sure that we know that their products are still available, what their costs are, what their appetite is. So that was over time. It was over 20 years building up that list. And that is sort of a, I don't know if we want to call it the holy grail, but for me, that's, I'm very protective of that. It's, it's a relationship.
It is
It's
an
a
asset,
relationship
right?
tool.
Yeah,
Absolutely.
Relationship is a key word here, because really what you're describing is relationship-based lending. It's building the relationship with the borrower, because you're trying to solve a problem for them. And, sometimes that solving the problem includes getting creative on finding the right lender partner to
That's right. That's right.
wow, they keep
And
hearing
presenting
no.
it.
There's got to be somebody out there who says yes. Let's figure out who that is.
That's right. You're absolutely right. And, and I'm glad you brought it up, because this kind of a business primarily is transactional, right? You call somebody, they find you the money, pay the fee, you're done, you're out. But things are a little bit different with us, because, as you know, you've owned businesses. You're right. You've operated businesses at a high level. You've been at upper management positions in companies before you bought and owned your businesses. Same thing with me. I bought and sold businesses. I've been in upper management positions. I know what it's like to run these businesses. So there's being transactional for me just doesn't make any sense, because I know what it takes to start these businesses, to run them, to get them to the point where you're going to exit or sell or whatever it is. So you have to have a relationship before they need the money, and you have to have a relationship long after. Because prime example, last week dealing with a specific client, and I said to him, I said, listen, you know what? The money that we're going to get you, I think it's $2 million. The money that we're going to get you is going to be great, but in 8 months from now, you're going to need more money, given the trajectory that you're on. And so, have you thought about what you're going to do? And he said, no, you know what? I haven't thought about what I'm going to do, because they're really thinking about, this is a Band-Aid. Let's put it on. That's great. I can make payroll for the next 6 months, and then we'll deal with it in 8 months from now. Well, no, we need to keep in touch. We need to make sure that we're ready for you, because when you need $3 million in a year from now, we need to make sure that we covered everything that previous 8 or 9 months to make sure that you can actually get that $3 million, or else you're going to be in this jam again. So, it's not transaction, payment, thanks. It's, what do you need now? What are you going to need in a year? How are we going to do that? How are we going to make sure that you're lined up for success? And that's relationship-based lending, in my opinion. And the lenders that we work with are very happy to be part of that conversation, because they know just as well as we do that you're going to continue to need money. Good businesses that are growing always need money. No matter how well they do, no matter how strong their cash flow is, you always need money. And so that's a misconception. People think, well, if I have to borrow money, I'm failing. No, actually, that's not the case at all. If you're not borrowing money, at some point, you're going to hit a wall, and you're not going to be able to get to that next level you want to get to, right? When you get to certain levels in your business, you have to change things up. You have to change from basic small business to corporate level. You have to change from a bookkeeper to a CPA. You have to change from a part-time controller to a CFO. It's just the natural progression of where you take your business. So you're always going to need the money. So for us, we always want to be on that speed dial, right? Sort of I joke, we want to be the heroes of the superheroes that can come in and help them when they need us.
That's it. Well, and what you're describing here, I think for some listeners who may be not that mature in terms of their the duration that they've been a business owner, they may be looking at this and saying, "Holy cow! He's right. I never thought of it that way." It's not about failing; it's about underperforming versus your potential, right? And I think this is one of those success secrets of people who grow businesses very, very quickly. Is they figure out how and when to inject cash into the business. And obviously, you can go the equity route or you can go the debt route. And the equity route is you're giving away some ownership to someone else. And not everyone loves that idea, right? There's a whole industry, private equity. I mean, that's what it's all about. But in essence, if that's what you're doing in order to raise money, you're giving away part of your ownership. And therefore potentially some of your control. So for those who don't like that idea at all, it's about, can I do a loan? Can I get debt? But then it gets paid back, and it gets paid back because the injection of funds creates more cash flow. and accelerates that cash flow turning faster, which then creates more cash, and on and on. And so you enables you to pay that one back. And as you pointed out, there's if I'm going to be on this growth trajectory, I know what today looks like. I know what I need today. Well, what about 12, 18, 24 months from now? That could look different still and accelerate even further. So is it scary for some? Yeah, probably, right? That's why we're in this conversation, Anthony, because you can help demystify some of this for a business leader. So let's
also
just
the technology. Sorry, just real quickly, the technology that we built together is meant to catch these things too. It's meant to alert us to certain trends and trajectory of the company and maybe some pain points, which is important because the lender's going to want to know what that looks like, and they're going to want to know if they've come up with a roadmap to get past that, right? And so that's an important part of the piece that we built as well.
Yeah. So part of the demystifying, I like that I used that word a minute ago, for an owner, a business leader, a decision maker who's like, what do I do here? Do I just keep slogging through day to day, or do I get some funds in and inject it in? There's a couple concepts that are really important. One is the return on investment. So someone might say, all right, well, if I go get $1 million, how do I know if it's worth it? And if I'm paying an interest rate, obviously, there's the question of, well, if I go to the standard bank, interest rate is going to be X. Well, if I went some alternative to the standard bank, is it going to be greater than X? Is the interest rate going to be higher? And I want your help, Anthony, to talk through and think about, that number called an interest rate percent is just one variable in one part of the equation. And I would suggest that, bringing it to understanding return on investment and enabling you to do something that you wouldn't have been able to do if you didn't have access to that capital. Would you mind, if I call that, present that as the conversation and take it away?
Yeah. So, and this comes up a lot actually, because I think everyone has an unrealistic view of how much money should cost. And sometimes, depending on where you fit in that, in that sort of spectrum, it may be 9% money, it may be 12% money. Not everybody can get 3% money, and it's getting harder and harder every day to get 3% money. So, with the discussions that we have, we're always very upfront about, hey, listen, here are the programs that are available. Here's the money that's available, and just so you understand, here's the cost of that capital, right? And the cost of the capital is changing all the time. Just because there's a lot of money in the market doesn't mean it's going to be cheaper necessarily, because they still have to get their specific rate of return. The investor, whether it's a bank or whatever, there's shareholders, there's people that need to get a rate of return. So the money's never cheap. When it comes to sort of figuring out that threshold of the cost benefit analysis of well, if I need $1 million and it's going to cost me 7% or 8%, is it worth it? And so I always pose the question back to the business owner, and I'll say, listen, can you grow your business today without that money? If it was just too expensive, do you have the luxury of saying, you know what, I'm good, I'll fund it myself? Can you do that? And of course, 95% of them say, well, no, I can't. Well, then that answers your question, right? So, you don't want it to get to the point where it's, 25% interest rate or 17% interest rate. There's a threshold where it doesn't make sense anymore. But if that's the case, then you have to evaluate why you can't get cheaper money. And there's a deeper problem there with why can't I get you 11% money? It's not because I don't know what I'm doing. It's not because I don't have the lenders. It's because there's a reason within the company or the structure or the way that the financials are reported that's creating this pricing concern, right? And so very recently had a client and was on the phone with them and discussing their balance sheet and discussing their financials. And they were frustrated that they couldn't get more money, and they were frustrated that they couldn't get it yesterday, and they wanted it to be the cheapest it could possibly be. And there were so many reasons why it just wasn't available for them. So it's a tough conversation to have, but it's also an internal conversation that you as a business owner have to have with yourself. So everybody, it's like when you've done renovations on your home, you put $200,000 into it, you think it's now worth $2 million, but the appraisers keep telling you it's worth only 1.2, right? And so everybody thinks that their business is worth more than it is. Everyone thinks that that the money should be cheaper than it is. But in reality, just because you put $200,000 into the home doesn't mean it's going to increase it by $1 million, right? And so we have to be very cognizant of that when we talk with our clients, the borrowers. They have to understand that there is a reason why money is priced the way it's priced. And if you can't qualify for that cheaper money, then we have to discuss why you can't qualify for that cheaper money. And if we have enough time and runway, let's fix that so that we can then qualify you for the cheaper money. And that's really how we like to position the conversation, because many borrowers are all about how much can you get me, and can you get it to me quickly. And sometimes it's a deeper conversation than that.
Yeah, and the relationship-based part of this whole thing, it might sound like this, where it's like, okay, I get that, what you want is, 2 million over the next, say, 12 or 18 months. What if we got you $500,000 on day one at this higher interest rate that you're not too happy about, but what the lenders are telling us is that XYZ need to be in place. And it's going to take you 6 months to get those things in place. So let's get those things in place. And then you could request the next tranche of money. The next chunk might be at that lower interest rate after you've had a chance to prove yourself out. The lenders are now happy giving you a lower price money, if you will, because you've gotten the things in place that need to be there, and you didn't wait to get started. You still got something to get out of the gates. And all back to return on investment. What did that enable for you that you can now do in your business that you wouldn't have been able to do otherwise?
Exactly. And let's be clear about something too. Lenders have been doing this for a very long time. So when they have their underwriting criteria in place, they do it for their protection as much as your protection, right? So there are many cases where somebody says, well, you know what, I've been in business for 3 years. I did $500,000 last year revenue, and I've got this huge purchase order that's coming in, and I need $2 million to fill it. Well, that's a huge jump, right? And so in my experience, in your experience in working with businesses and even my own businesses in the past, if you explode in growth that quickly, you are going to hit a wall because you're not prepared for it. And you have to incrementally increase that. You have to get the right staff involved. You have to have the right processes in place. You have to have the right accounting systems. You have to have everything there ready to go, because you inject $2 million and you've got a new contract, you've got all these demands, and you've got to meet all these deadlines and these deliveries and these orders and everything. You won't be able to keep up. We've rarely seen one that has. And so the lenders aren't stupid. They know that. And so they want to support you. But you know what, let's do it in bite-sized pieces, right? You can't eat the elephant you have to eat it one bite at a time, right? You can't eat the whole elephant at once. And that's how lenders look at it. So like you had mentioned before, a tranched out scenario where, okay, you know what, let's give you $500,000 first, because we know that you'll be able to cover those payments based on your current financial statements, right? And then if we look at this in 6 months and we take a look at your terms and we see that everything is tracking as it should, we'll give you some more, sure. But they're not just going to give you $2 million, to buy a bunch of inventory or equipment or something, because they know it's going to be very, very difficult. And they don't want to put you in a position to fail, and they don't want to put their capital at risk.
Right. And this conversation is for, companies that are struggling with something, as well as those who are really healthy and have huge aspirations. And so let me play a couple scenarios. What are the top, say, 3 or 5 things that you see that are reasons why a really healthy company would ask for money?
Well, the first one that jumps out at me always is, like we just mentioned, a huge upswing in customers, whether it's an order, it's a purchase order, it's a new customer contract that's been signed and they need to fulfill this contract. That is always a good reason for capital. Another good reason for capital is, depending on the industry you're in, there may be some competitors in the space, and you may want to expand through acquisition. And we see that all the time where, you've got an industry leader, and there may be some others that are kind of poking around, maybe taking bites out of a little bit of your business here and there, or they may have a complementary service where you can integrate into your business, or they may have a software or some IP or something that would really help you scale your business up. That is a smart move when it comes to accessing capital. We've done that many times in the past for clients where they're either consolidating some companies together, they're merging them, or they're just going, they grow through acquisition. That's another one. Another good reason for capital or kind of exploring capital options would be you've got a logistics trucking company, or you may have a private garbage service or something where you've got big equipment or yellow iron, or you do excavating or whatever the case is, and you're expanding, but you also have equipment that needs to be kept up, and the older equipment gets, the more hours on it, the more expensive it becomes. And sometimes it's cheaper and it's more cost effective to increase the size of your fleet, maybe refinance that, or just go out and buy new equipment. And financing, there's very good financing options for that, and they're accessible. So those, I would say, would be probably the three that we see the most. When it comes to financing requests, right? I mean, there's always other ones where, working capital for bringing on new staff. If you're expanding, you want to increase your market share, not through acquisition, but you want to, spend a lot more money and time, build out your social media team, your marketing team. Everything is online now. You want to expand into different cities, states, provinces, wherever you are in North America. Working capital is available for that too. So those would be the ones that we see the most.
Yeah, and those are all growth scenarios, right? I mean, there's the obvious, when someone's not healthy or struggling, and they, something maybe bad happened. A giant customer disappeared overnight, and they lost, a huge chunk of their revenue as a percent, and now they've got to make up some ground. Obviously, an underwriter is going to see all of that. They're going to want to know the story, so that might be a tougher sell. But nonetheless, there are the bad things happen, and you need to fill a short-term gap. But there's the growth, right? The growth side, the positive side is very exciting. Those reasons you just described. So we should wrap up. Is there anything, just in closing summary, Anthony, that you really want to, make sure that people are aware of when it comes to how do I think about my decision to go request money?
Well, I think you've probably heard me say this several times in the past, and I always get a chuckle when I say it, but Noah built the ark before it rained, right?
Yeah.
And so the biggest thing for me is, I wish I could scream it from the rooftops, that please don't wait until you absolutely need the money. Everybody has to do, it's like doing a physical once a year, right? Or whenever it is that you do it. You should be doing a periodic physical for yourself, but you should be doing a periodic check on your business and trying to figure out, okay, here's where we are, here's where we want to be in 9 months or 12 months. What do we need to do to get there? And, the biggest problem is when you're an entrepreneur and you're going at the speed of light and you're doing everything yourself, and you're cleaning the bathrooms and you're fulfilling orders and you're doing the books, you don't have a lot of time to sit down and think about, where am I going to take this thing? You're in it day to day, right? And so what I would say the biggest thing is that really start thinking about where you want to be in 12 months. And then we can help formulate that plan, make sure that you have things in place so that when you do need that money, because you're going to need it, when you need that money, that we've already been working on this for several months with you, so that we can make sure that we present this in the best way possible. And so that is the biggest thing for me is, knee-jerk reaction stuff creates panic, creates anxiety, it creates stress for you as a business owner, and that doesn't help when we're trying to go and get you money. So, everybody should be talking to us well before they need it. So that's the biggest thing, and I can't stress that enough, and I wish more people would take advantage of that and say, hey, you know what, I've been around for 3 years, 4 years, doing well, don't need the money today, but I'm probably going to need some, or I'm kidding myself, and I don't think I need any. Do you think I need some? Even those conversations, love to have them, because then we can really extract all that information and maybe help them understand that you're going to need money. Let's get on this now, before you take a bunch of money out of your company and buy a boat and buy an extra car and go on vacation and do all this stuff. Let's think about these things first before you do them.
Yeah, and sometimes you do a dry run and you realize, oh, I have a few gaps that are easy to fix, but they're going to take 3-6 months to fix them. And so let's
Exactly.
learn that today
Exactly.
before the need is there.
Exactly.
Excellent. Really great conversation. And there is a demystification that's happening here as we're talking about this. I've been, in lots of conversations with businesses as a business, as you pointed out, business consulting, business advising, and there's all kinds of pain points and struggle and frustration that business owners and that leadership team, that they sometimes, they just, I'm going to tighten the belt. I'm going to bite my lip harder and I'm going to fight through this. And sometimes that's okay for the short term. You want to get through a few weeks, bite your lip harder, go for it. But what if it were easier, right? What if there was an easier way? And I think, hopefully this conversation today, all you listeners catching some of what Anthony was describing, you've got this new picture of what the potential is for an easier way that delivers you the ROI that you're looking for. So love it. Love it. Love
Absolutely.
it.
I always appreciate chatting with you. We chat all the time, but it's always nice to really drill down and talk about this more. Obviously, you can see that we both are passionate about being involved in it. So I appreciate you bringing me in on this conversation today.
Yeah, thank you again, Anthony, for your time. So everyone, today conversation was with Anthony de Almeida from Imagro, and Imagro, is Imagine Growth. So helping you to imagine growth for your business. Take care, everybody.
Thanks for listening to this episode of Business Results Radio. Remember to share this episode on social media or directly with people you think would benefit from it. And if you are willing, subscribe to this podcast and give us a 5-star rating. Go ahead and do that now while you're thinking of it. I also want to invite you to visit businessresultsradio.com